Challenging market conditions have weighed on 91. The asset manager has posted a 3% drop in assets under management and outflows of £9.4 billion for the year to end March. Given the performance, the firm has cut its dividend. A final payment of 6.4 pence has been declared. This takes the total to 13.3 pence, which is a near 7% slide. Vukile has given shareholders a reason to smile. The property fund has declared a final dividend of 72 cents. This takes the total payout to 124 cents, which reflects an increase of 10.5%. That's as the group managed to increase funds from operations per share by 6.7% during the year to end March. Looking ahead, Vukile says it remains on track to deliver further growth for its investors. It expects annual funds from operations per share to rise by as much as 4%, and its forecast dividend growth of between 4 and 6%. Capital Appreciation has almost doubled its full-year profit. The fintech group's headline earnings per share rose 83% during the period. That's thanks to robust demand for the firm's technology solutions, products and services. A final dividend of 5.75 cents per share has been declared. This brings the total payout for the year to 10 cents. That's an increase of 21%. Signia has delivered an improved half-year performance. The firm's posted an 8.7% rise in revenue, while headline earnings per share increased by close to 10%. Signia has pointed to growth of assets under management and administration from a mix of institutional and retail clients. That metric came in 9% higher at just over 312 billion rand. It's added that the results are also cyclical, reflecting the performance of the markets and currency. Fitch has warned of risks to South Africa's public debt trajectory and macroeconomic stability. That's if the ANC forms a government that relies on the support of Umkhonto weSizwe or the EFF. The ratings agency says the move would weaken investor confidence and potentially erode governance. And this could happen even if the most radical policies do not come to pass. As a result, the election outcome raises new risks for the country's credit profile. Standard Bank, on the other hand, is more optimistic. The lender's CEO, Sim Tshabalala, says the firm will work with any government chosen by the electorate, and he's hopeful that the stability will reign. Tshabalala also commented that 8 of the 10 elections in South Africa since 1980 were followed by rallies in the equities, bond and currency markets, and he believes that the same will happen this time around. Business confidence edged up in the second quarter. The RMB BR morale indicator rose by 5 points to 35. The increase follows 2 consecutive declines. Confidence rose in 4 of the 5 subsectors, except for new vehicle dealers. According to RMB, 2 salient features could have played a role in the results. This includes uncertainty around the election, which was top of mind for many respondents, and then the lack of load shedding for over a month prior to the survey, which could have had a more positive impact on survey respondents. On the international front, Zara owner Inditex reported a pickup in recent sales from its spring-summer collections, boosting its shares on today as the world's top fashion retailer delivered quarterly results in line with expectations. Let's take a look at this package report for more.
Shares in Zara owner Inditex jumped on Wednesday after it posted a lift in sales from its spring-summer collection. The world's top fashion retailer said sales rose 12% from May the 1st to June the 3rd, from the same time the year before, which one analyst attributed to pent-up demand following a rainy start to the season. This upbeat start comes as it reported quarterly sales and profits that met expectations. It also posted a 7% rise in sales for its first quarter to the end of April. That marked an expected slowdown from a year earlier, when the company benefited from a shopping spree following the global health crisis. Inditex, whose brands also include Pull&Bear and Massimo Dutti, is battling intense competition from rivals such as H&M, Shein and Temu. To entice shoppers, Inditex is chasing and delivering fashion trends faster by investing in logistics and technology, and said it plans to invest close to $1 billion per year through 2025 to further expand logistics capacity. The company has outperformed rivals in recent quarters, benefiting from investments in new store and online experiences, such as live stream shopping.
And the European Commission has committed to a significant compensation package for an Eastern German region transitioning away from coal over the next decade. This agreement could significantly impact the country's decarbonization efforts. Here's our reporter Natindevu with more.
That's right, Zinati. The European Commission has agreed to a massive payout to compensate an Eastern German region for exiting coal over the next decade. Now, it's a deal that could be a game changer for the country's efforts to decarbonize. And Lars Halter is with DW and joins me now from Berlin. Lars, what can you tell us about this deal?
Yeah, thanks for having me. Yes, a German government was relieved to finally seal this deal. The EU has approved of a massive payout for the Lausitz region. Berlin will transfer the sum of 1.75 billion euros to that region, just a few kilometers south of the German capital. Now, let me tell you something about that place. For decades now, going far back to when Germany was divided and the Lausitz was part of former East Germany, for decades this area has been sort of the engine of the state, generating most of its power, mining coal in giant surface pits and burning it in dozens of power plants. Hundreds of thousands of jobs were tied to the energy sector. But of course, it's been clear for a long time now that coal was on its way out. The Lausitz area has already seen some structural change with some mining ending, power plants being shut down, but they are still a few steps away from reaching the German government's declared goal to completely shut coal-fired power plants by 2038 and to become climate neutral by 2045.
Now, Lars, what exactly will happen with that money?
Well, first of all, it will come in two tranches. 1.2 billion are going to be transferred pretty much right away to a company called LEAG, and that is the energy provider in the region that owns and runs the power plants. And now, that money is meant to help the company shut down operations in a way that doesn't upend everyone's lives. The company will have to compensate workers it might have to let go. It will have to retrain employees for new jobs, possibly even staying in the energy sector, but switching to the solar or wind side. Now, of course, that would need an entirely different skill set, and it takes money and lots of time to provide people with the skills they might need in a post-coal world. The rest of the money, another $500 million, is meant to compensate the company if it can show that it does actually lose money during its own transition. Also, whether directly or indirectly, lots of money will be spent on helping the region transform. And that's a long-term process that has, in fact, already begun. I know of one surface mine, for example, that has been turned into a giant lake. It's become a summer attraction for locals and tourists alike. Now, there's generally an effort to build up industries, including tourism, to make sure the Lausitz area will remain a viable economic area.
Lars, there's something about the timing of this deal, isn't there? So why has Brussels agreed to these payments just now?
Well, there is no official word, obviously, on the timing, but one can't help to see a connection between this deal and the upcoming elections this coming weekend. The Germans will have communal elections where local and state governments will be voted in or out. Also, folks around the continent will vote for the European Parliament. And the EU is not particularly popular these days. It's a huge bureaucratic giant that is moving slowly, hardly gets anything done for structural reasons. And as we're dealing with rising levels of populism in many parts of the world, there's voices within Germany as well that have been calling for the country to drop out of the EU. Now, the EU working seemingly efficiently with the German government to protect the economic interests of a major region is certainly one way to make sure that voters will stick with the established parties and just give that whole idea of a strong, united Europe another chance.
Well, let's leave it there for now. Lars, thank you so much for those updates. That was DW's Lars Halter.